You are sitting at a red light in a nice part of town. Maybe it's Beverly Hills, maybe it's Miami, or maybe it's just the upscale suburb of your city. You look to your left. There is a pristine, blacked-out Mercedes G-Wagon. You look to your right. A brand new Range Rover autobiography. You look in the rearview mirror. A Cadillac Escalade is towering over you. You might look at these drivers and think, wow, they must have a lot of disposable income to burn $2,000 a month on a car payment. You might think they are just showing off. You might think it is pure ego, pure flex, pure vanity. And you would be wrong. While you see a luxury liability that loses value every time the wheels turn, the person behind the wheel sees something completely different. They see a tax shield. They see a strategic asset. They see a way to move money from the IRS's bank account into their own driveway. The reason you see so many real estate agents, doctors, consultants, and business owners driving vehicles that weigh over 6,000 pounds is not just because they like being tall. It is because of a specific line in the United States tax code that turns a luxury purchase into one of the most powerful wealth preservation tools in existence. My name is Conrad, and welcome to Wealth Architecture. Today we are not talking about saving pennies on coffee. We are talking about the G-Wagon Loophole, formerly known as IRS Section 179. I am going to explain exactly how the wealthy write off their lifestyle legally. I am going to break down the math of how you can buy a $150,000 vehicle and have the government effectively pay for 40, 50, or even 60% of it. I am going to give you the specific list of vehicles that qualify in 2026. But more importantly, I am going to tell you the things your accountant is too lazy to explain. The traps, the recapture rules, the commuting fallacy, and how to audit-proof this strategy so you don't end up in a room with a federal agent explaining why you needed a twin-turbo V8 to drive to a coffee shop. If you are tired of paying taxes first and spending what is left, and you are ready to start spending first and paying taxes on what is left, you are in the right place. Let's dismantle the code. To understand why this strategy exists, you have to understand the fundamental difference between how the middle class is taxed and how business owners are taxed. It is a game of order of operations. If you are a W-2 employee, you earn money. Then the government takes their cut: federal tax, state tax, FICA, Social Security. Then you get what is left. You try to pay for your car, your house, and your life with after-tax dollars. You are buying a $50,000 car, but you had to earn $75,000 to pay for it. The business owner plays by a different set of physics. We earn money. We spend money on necessary and ordinary business expenses. And then, we pay tax only on the net profit that remains. The government incentivizes business owners to reinvest in the economy. They want you to buy equipment. They want you to buy machinery. They want you to stimulate growth. So, they created the tax code to reward spending. Now, usually the IRS is very strict about cars. They know that everyone wants to drive a nice car and call it a business expense. So, for decades, they have had what are called luxury automobile depreciation limits. If you go out and buy a regular sedan, a Toyota Camry, a BMW 3 Series, a standard Mercedes C-Class, the IRS puts a cap on how much you can write off. It doesn't matter if you use it 100% for business. They limit your depreciation deduction to a relatively small amount per year, usually around $18,000 to $20,000 in the first year, and then it drops off significantly. It takes years and years to write off the full value of the car. It is slow. It is inefficient. It does not help your cash flow today. But then there is the exception, the heavy exception. The tax code was written with farmers, construction workers, and industrial businesses in mind. The government wanted to make sure that a farmer buying a heavy-duty tractor or a construction company buying a massive flatbed truck could write off that equipment immediately. They didn't want a farmer to have to wait 5 years to deduct the cost of a tractor, so they drew a line in the sand. They decided that any vehicle with a gross vehicle weight rating, GVWR, of over 6,000 pounds is not a passenger automobile. In the eyes of the IRS, it is heavy equipment. It is machinery. And because it is machinery, it is not subject to the luxury automobile limits. It falls under Section 179 of the IRS tax code. Section 179 allows a business owner to deduct the entire purchase price of qualifying equipment in the year it is placed in service, up to a certain limit, which in 2026 is well over $1 million. This means you can go to the dealership on December 31st, buy a vehicle that weighs 6,001 pounds, put it in service that day, and potentially write off the entire purchase price against your taxable income for that year. This is why the G-Wagon is the icon of this strategy. The Mercedes G63 AMG is a military-derived truck. It is heavy. It weighs well over 6,000 pounds. It fits the definition of heavy equipment just like a tractor does. But instead of plowing fields, it plows through traffic on Wall Street. Let's look at the math, because this is where the light bulb usually turns on for people. Let's assume you are a successful real estate agent, a consultant, or a small business owner. You have had a great year. Your net income, your profit, is $500,000. If you do nothing, you are going to get crushed by taxes. You are likely in the 35% or 37% federal tax bracket. Depending on where you live, California, New York, or even a state with moderate taxes, you are looking at a combined marginal tax rate of probably 45% or more. That means on that last $150,000 you earned, the government is going to take nearly $70,000. Poof, gone. Now, let's say you decide to use the Section 179 strategy. You go out and buy a new Range Rover or G-Wagon for $150,000. You use it 100% for business. You qualify for Section 179. You take a deduction of $150,000 against your income. Your taxable income drops from $500,000 down to $350,000. Because you are in that 45% marginal tax bracket, that $150,000 deduction saves you approximately $67,500 in actual cash taxes that you would have had to write a check to the IRS for. Think about that. You bought a $150,000 car, but the government effectively gave you a $67,500 discount. Your net cost for that vehicle is roughly $82,500. You just bought a super luxury vehicle for the price of a well-optioned Ford Explorer. This is why the wealthy do it. It's not because they want to spend $150,000. It's because they have to choose. Do I send $70,000 to the IRS and get nothing in return? Or do I spend that money on an asset that I get to drive, enjoy, and use to build my business? When you look at it that way, buying the car is actually the conservative financial move. Now, before you rush out to the dealership, we need to talk about the nuances, because the IRS is not stupid. They know this loophole exists, and they have strict rules. If you mess this up, you don't get a deduction, you get an audit. The first and most important rule is the business use percentage. To qualify for Section 179 at all, the vehicle must be used more than 50% for business. If you use it 49% for business and 51% for personal reasons, you get zero Section 179 deduction. None. You are back to the slow, painful depreciation schedule. But it gets deeper. Your deduction is proportional to your business use. In my example, I said you used it 100% for business. In the real world, that is very rare unless you have a separate car for personal use. Most entrepreneurs have one car. Let's say you buy that $150,000 G-Wagon, but you use it 80% for business and 20% for personal use. Groceries, dropping kids at school, going to the movies. The IRS says you can only deduct the business portion. So $150,000 times 80% equals $120,000. That is your eligible deduction basis. You can write off $120,000. The remaining $30,000 is considered personal consumption and provides no tax benefit. This leads us to the single biggest point of failure for this strategy, the definition of business miles. Most people think, I drive to work, that's business. Wrong. Dead wrong. Commuting, driving from your home to your regular place of business, is never deductible. It is personal. The IRS is crystal clear on this. If you drive from your house in the suburbs to your office downtown, that is a personal commute. Even if you take a business call on the way. Even if your car has your logo on the side. It is commuting. So how do the wealthy get around this? How do they get to that 80% or 90% business use? They hack their principal place of business. If you have a legitimate qualifying home office, a dedicated space in your home where you conduct administrative and management activities, then your home is your principal place of business. Now, when you leave your driveway to go to a client meeting, to go to a job site, or even to go to your second office, you are not commuting. You are traveling from one work location to another work location. That is deductible business mileage. This is the home office hack that unlocks the vehicle deduction. By establishing your home as your HQ, you turn your first drive of the day and your last drive of the day into business miles. But you have to prove it. If you get audited, the agent is going to say, "Show me the log." If you say, "I don't have a log, but I promise I used it for business," they will disallow the entire deduction. They will add penalties. They will add interest. It will be a nightmare. You need a mileage log. In 2026, you do not need a notebook in the glove box. Use an app. Mile IQ, Sherpa Share, QuickBooks Online. These apps run in the background on your phone. You swipe left for personal, right for business. At the end of the year, you download a PDF that complies with IRS requirements. It shows the date, the destination, the purpose of the trip, and the miles. That PDF is your bulletproof vest. If an auditor sees that, they usually back off immediately because they know you are organized. Let's talk about the vehicles. What actually qualifies in 2026? We are looking for a gross vehicle weight rating, GVWR, of 6,000 pounds or more. You can find this number on the sticker inside the driver's side door jamb. Do not guess. Check the sticker. Here are the heavy hitters that qualify. Obviously, the Mercedes G-Class, G550, G63. It's a tank. The Range Rover, full-size, and the Range Rover Sport. The Cadillac Escalade and the Chevy Tahoe Suburban. The Jeep Grand Wagoneer. The Lincoln Navigator. The Porsche Cayenne. Certain trims are close, check the sticker, but usually the turbo or e-hybrid hits the weight. The BMW X5 and X7. Note, the X5 is tricky. Some trims are under 6,000 pounds, some are over. Usually the V8s or the hybrids are heavy enough. Always check the door jamb. And then we have the electric vehicle sector. EVs are heavy because of the batteries. This makes them perfect for Section 179. The Tesla Model X, it qualifies easily. The Rivian R1S and R1T, massive weight, full deduction. The Ford F-150 Lightning. The GMC Hummer EV, obviously. The Audi Q8 e-tron. Wait, Conrad, what about the Tesla Cybertruck? Yes, absolutely. The Cybertruck is well over 6,000 pounds. It is a Section 179 beast. In fact, because it looks so distinctive, it's even easier to justify as a marketing vehicle for your brand. Now let's address the elephant in the room, the SUV cap. I need to get technical for a second. Section 179 has a limit for sport utility vehicles. If the vehicle is a truck with a 6-foot bed, like a Ford F-150 or a Silverado, there is no cap. You can write off a $100,000 truck fully. However, for SUVs, vehicles with 4 wheels and a passenger cabin, Section 179 effectively caps the specific Section 179 deduction at roughly $30,000, adjusted for inflation annually. Wait, you scream. You just said I could write off the whole thing. You lied. Hold on, I didn't lie. This is where bonus depreciation comes in. Section 179 is one part of the code. Bonus depreciation, Section 168K, is the second part. Bonus depreciation allows you to deduct a percentage of the remaining cost after Section 179. For a long time, bonus depreciation was 100%. That was the golden era. However, under the Tax Cuts and Jobs Act, bonus depreciation has been phasing out. In 2023, it was 80%. In 2024, it was 60%. In 2025, it was 40%. In 2026, under current law, bonus depreciation drops to 20%, and in 2027, it goes to 0. So, is the loophole dead in 2026? No, it is just slightly less explosive, but still incredibly powerful. Let's rerun the math for 2026 rules. You buy a $150,000 G-Wagon, 100% business use. Step 1. Section 179 deduction. The IRS caps the SUV deduction around $30,000, inflation adjusted. Remaining basis, $120,000. Step 2. Bonus depreciation, 20%. You take 20% of the remaining $120,000. That's $24,000. Total first-year deduction, $30,000 plus $24,000 equals $54,000. Only $54,000, you ask? That's not the whole car. Correct. In 2026, you get a massive upfront chunk, $54,000, and then the remaining balance, $96,000, is depreciated over the standard 5-year MACRS schedule. So you still write off the entire car, just not all in year 1. You get a huge hit in year 1, and then nice, steady deductions for years 2, 3, 4, and 5. However, and this is a big however, if the vehicle is a truck, not an SUV, like a customized G-Wagon 4x4 squared, or a pickup truck, or a cargo van without rear seating, the SUV cap does not apply. You can write off much more using straight Section 179. This is why you see so many pickup trucks on construction sites. They bypass the SUV cap completely. But let's go back to the mindset. Even a $54,000 write-off in year 1 is powerful. That's a roughly $25,000 cash savings in taxes immediately. That covers your down payment. The tax savings pay for the entry into the asset. Now I need to warn you about the trapdoors. The things that can blow this whole strategy up. Trapdoor number 1, the recapture nightmare. You buy the G-Wagon in 2026. You claim 100% business use. You take the deduction. In 2027, you get lazy. You stop tracking miles. Or maybe you retire. Or you just start using the car to drive to the golf course every day. Your business use drops to 40%. Guess what? The IRS says, hey, we gave you that deduction because you said this was a business tool. Now it's a personal toy. They will recapture the excess depreciation. That means you have to add that deduction back into your income in 2027 and pay taxes on it. It is a time bomb. If you start this strategy, you must maintain over 50% business use for the entire 5-year recovery period of the vehicle. You are married to this logbook for 5 years. Do not forget this. Trapdoor number 2. Buying in your personal name. Do not do this. The vehicle should be titled in the name of the business, LLC or Corp. It should be insured under a commercial policy. It should be paid for using the business bank account. If you buy it in your personal name and try to lease it back to the company, or just deduct it on your Schedule C, it is much messier. It raises red flags. Build the corporate veil. Put the asset in the entity. Trapdoor number 3, the exit tax. This is the one nobody talks about until they sell the car and get a massive tax bill. Let's say you bought that car for $150,000. Over 5 years, you wrote off the entire $150,000. In the eyes of the IRS, your basis in that car is now 0. You have claimed 100% of its value as an expense. Now, you decide to sell it. The G-Wagon holds value well. You sell it for $100,000. You think, great, I got $100,000 cash. The IRS says, not so fast. Since your basis is 0, that entire $100,000 sale price is considered depreciation recapture. It is taxed as ordinary income. You effectively have to pay back the tax savings on the amount you sold it for. So how do the wealthy avoid this? They never cash out. They trade up. In the old days, we had something called a 1031 exchange for cars, where you could roll the value over tax-free. That was killed in 2017. Now, the strategy is this. You trade in the old G-Wagon for a new G-Wagon in the same tax year. The trade-in value is income, yes, but the purchase of the new car creates a new Section 179 deduction that offsets that income. It is a treadmill. Once you get on the heavy SUV tax deduction treadmill, it is very expensive to get off. You have to keep buying new heavy vehicles every 3 to 5 years to offset the gain from selling the old ones. It's not a bad treadmill to be on. You always drive a new car, but you need to know that you are on it. A common question I get. Conrad, should I lease or buy? Generally speaking, Section 179 requires you to purchase the vehicle. This means paying cash or financing it with a loan. If you do a standard operating lease, where you turn the car back in at the end, you cannot take the Section 179 deduction. You can only deduct the monthly lease payments as they occur. However, you can deduct the lease payments based on business use percentage. And for luxury cars subject to strict depreciation limits, leasing is sometimes actually better because it bypasses the depreciation caps entirely. You just write off the lease payment times the business use. But if you want that massive upfront lump sum deduction to wipe out a huge profit year, you have to buy. Note, there is something called a capital lease or $1 buyout lease, which counts as a purchase. If you finance via a capital lease, you can take Section 179. Ask your dealer specifically for this structure. Let's talk about reasonable and ordinary. Is a $200,000 Lamborghini Urus ordinary and necessary for a real estate agent? The IRS might argue no. They might say it is lavish and extravagant. However, courts have generally ruled that if it helps you generate income, it is valid. If you are selling $10 million mansions, driving a Lamborghini helps you fit in with your clients. It is marketing. If you are a plumber, maybe stick to the Ford F-250. Context matters. Don't be greedy. The pig gets fed, the hog gets slaughtered. A G-Wagon for a high-end consultant? Defensible. A Ferrari Puro Sangue for a freelance graphic designer working from a basement? You are asking for trouble. Let's zoom out. Why does this matter? This is about lifestyle design. The average person looks at a car as a cost. The wealth architect looks at a car as a bundle of after-tax versus pre-tax dollars. If you are going to spend the money anyway, structure it so the government subsidizes it. If you make $500,000 and you don't have any write-offs, you are voluntarily tipping the government. I don't know about you, but I think the government wastes enough of our money. I would rather that money sit in my driveway, wrapped in German engineering, keeping my family safe and projecting success to my clients. So, here is your action plan. Check your income. Do you have a tax problem? If you don't have a profit, you don't need a deduction. You can't use Section 179 to create a loss. It can only take income to zero. It can't go negative. You need profit first. Check your vehicle need. Do you actually need a car? Can you legitimately justify using it 50% plus for business? Check the weight. Look for that 6,000-pound GVWR. Consult your CPA. Do not take tax advice from a YouTube video alone. Tell your CPA, I am planning to acquire a heavy SUV for business use, and I want to maximize my first-year depreciation using Section 179. Can you run the projection for me? If your CPA says, you can't do that, fire them. Find a CPA who understands real estate and business taxation. The G-Wagon Loophole is not a secret code. It is printed in black and white in the IRS instructions. It is an incentive. The government is begging you to invest in your business. So go ahead. Take them up on the offer. Drive the car you want. Pay the tax you legally owe, and not a penny more. If you enjoyed this breakdown, you need to subscribe to Wealth Architecture. We are taking apart the financial system brick by brick and rebuilding it in your favor. And let me know in the comments, what is your dream Section 179 vehicle? Are you Team G-Wagon, Team Range Rover, or Team Cybertruck? Put it in the comments. I read all of them. I'm Conrad. Stop commuting. Start traveling for business. I'll see you in the next one.